Hi guys, welcome back to the channel. Today we're going to take a deep dive into the US national debt, its relentless growth, and what it could mean for our cost of living and the dangers of a financial collapse. We're going to unpack the complex reasons why the US will likely never pay down its debt and explore the potential consequences for everyday Americans. So let's get into it. First, let's start with a bit of history. The US national debt has been on an upward trajectory for over a century, ballooning from $404 billion in 1923 to a staggering $34 trillion as of January of 2024. This trend is a clear indicator that the US consistently spends more than it collects in revenue. Think of it like this. Imagine you have a credit limit on your credit card and you consistently max it out every few months or so. Then you call the bank to ask them to raise your limit so you can go and spend more money. I would say that's reckless, unsustainable, and quite stupid. Well, in a nutshell, that's what the US government does every year when they keep raising the debt ceiling. One of the biggest challenges in reducing the debt is the interest payment. See, as the debt grows, so do these payments, which in turn add to the overall debt. In 2022, interest costs were $476 billion and are projected to rise to $1.4 trillion by 2033. This money could have been used for public investment or to reduce taxes. During the economic downturn, such as the Great Recession of 2008 and the COVID-19 pandemic, the government ramped up spending to stimulate the economy. While these measures can help in the short term, they significantly increase the national debt. Reducing the national debt will likely require spending cuts and tax increases, both of which are politically difficult to implement, especially in an election year. No politician wants to do that, not if they want to get reelected. Spending cuts could lead to a reduction in public services, while tax increases are generally unpopular among voters. So we find ourselves in a bit of a conundrum here. Some economists argue that the debt-to-GDP ratio, which currently stands at 120%, is a more important measure than the absolute amount of debt. It indicates the country's ability to pay back its debt as long as the economy grows at a rate higher than the interest rate on that debt. The debt can be sustainable. But what if the economy does not grow or slow down like what we saw happen during the COVID pandemic? When the pandemic resulted in strict lockdowns and travel restrictions, which has significant impact on global supply chains, consumer demand, and financial markets. Investors became increasingly concerned about the economic consequences of the pandemic, leading to a rapid sell-off in stock markets around the world. The crash was particularly severe in March of 2020, when the Dow Jones Industrial Average experienced its worst day since 1987, falling over 2,000 points in a single day. Other major stock indexes, such as the SP 500 and the FTSE 100, also experienced significant losses. From February 12th through March 23, 2020, the Dow Jones Industrial Average lost 37% of its value. So how did the US government and many other governments around the world respond to all of this financial turmoil? By printing money and issuing new debt to pay off old debts. You see, the government has to strategically manage its debt to stimulate economic growth, fund public services, and meet other national objectives. So the Fed went on a printing spree like never before, leading to inflation, which the impact is still being felt today. Guys, if you find value in this video, please hit the like button, subscribe, and share this video, as it will help this channel in a big way. Thank you. So back to the video. Now let's talk about the impact on the cost of living. High levels of debt will affect many other aspects of the economy in the future. For example, higher interest rates resulting from increased federal borrowing would make it harder for families to buy homes, finance car payments, or pay for college. Fewer education and training opportunities stemming from lower investment will leave workers without the skills to keep up with the demands of a more technologically based global economy. Faltering support for research and development will make it harder for American businesses to remain on the cutting edge of innovation and would hurt wage growth in the United States. Furthermore, slower economic growth generally will make our fiscal challenges even worse, as lower incomes lead to small tax collections and put the federal budget further out of balance. Vital safety net programs would come under even greater budgetary pressure, threatening support for those who need them most. The dangers of a financial collapse are real. If investors begin to doubt the government's ability to repay its debt, they could demand higher interest rates. A rapid increase in treasury rates could also lead to higher rates of inflation, which would reduce the value of outstanding government securities and result in losses by holders of those securities. Now, who are those holders? That's including mutual funds, pension funds, insurance companies, and banks, which could further destabilize the U.S. economy and erode confidence in the U.S. currency on an international scale, leading to a financial crisis. While it is theoretically possible for the U.S. to pay down its debt, it's unlikely due to historical trend, interest payments, economic stimulus measures, political challenges, and strategic debt management. On the other hand, reducing federal borrowing would counter such effects. According to the CBO, the Congressional Budget Office, income per person could increase by as much as $6,300 by 2050 if we were to reduce our debt to 79% of the size of the economy for that year. The focus should be on managing the debt effectively and ensuring that the economy continues to grow. However, I seriously doubt the government will stop borrowing, printing money like crazy. And that is it for today, guys. If you find this information valuable, please like, share, and subscribe for more insightful discussions. Stay informed, stay prepared, and I'll see you soon.